Well, 1 year ago, investors woke up to shocking news. China had devalued its yuan currency by some 2%, and that sent stocks sharply lower. Here with more is Ian Gordon, an FX strategist at Bank of America Merrill Lynch. And Ian, it's good to see you. So it was the morning of August 11th, 2015, and the chart I'm about to show describes the situation perfectly. There you see the renminbi plunging. That's the orange line, and then the blue line is the S&P 500. The beginning of that line is at 9:30 a.m. on August 11th of last year when U.S. markets opened. Look at that steep decline there. The S&P 500 ended up losing almost 1% that day. So Ian, briefly refresh our memories of what happened that day.
Yeah, so I mean, basically what happened is the PBOC decided to implement a one-off devaluation of the renminbi in order to regain some of its control of monetary policy in an environment where the Fed was getting ready to hike rates, or at least so we thought in September of the following month. And so the market reaction was, kind of very surprised at this and really didn't understand immediately, what the ramifications were going to be. So we saw risk sentiment take a very large hit on the back of that, and it really spilled over to several different markets outside of just the currency markets.
Well, and what took place on August 11th is largely credited with causing that stock market correction we saw on August 24th. And I'm wondering why we don't hear much about the renminbi anymore. Is it more of a factor of, central banks are more involved in the markets this year than they were last year, and investors just assume that support will continue?
I think it's a couple of things. I think one, that the Chinese authorities have started to do a better job communicating their intentions and the expectations about what the currency, the renminbi, is going to be doing. So that's helped to stabilize, investor sentiment and expectations a bit. I think they've also put into place capital controls, which have also helped to stabilize the capital outflows, which were a large driver of the weakening in the renminbi that we saw subsequent to the devaluation. And lastly, we've been in an environment where their dollar has actually been, on a back foot and has weakened so far this year. So this has really taken pressure off the PBOC from devaluing or depreciating the currency more aggressively, and allowed them to do it in a more defined and more orderly manner, which is something that we think is going to continue.
Now, you're following this, very closely. The renminbi is down, almost 5% against the dollar over the past 12 months. What do you think is in store next for the currency?
So we actually see the renminbi continuing to weaken over the course of this year. We forecast the dollar-China exchange rate to rise to 7 by the end of this year, stay at that level through mid-2017, and then see the pair falling down towards 6.8 by the end of 2017. And really that's just a function of what I just mentioned. In an environment where the PBOC doesn't want to use lower lending rates or lower policy rates to support, kind of weak growth in China, they're going to need to use the currency to do that. And so we do still see them using the currency to ease financial conditions and ultimately support growth over the course of this year.
And just very quickly, because we're running out of time, what are you telling clients about the renminbi? Is it time to short it?
Absolutely. We do think it's time to short the renminbi. We do prefer doing it against more of a basket of currencies rather than just against the dollar specifically, just given some of the risks around the dollar. But we do think at these levels it is an attractive short.
All right. Ian Gordon, an FX strategist at Bank of America Merrill Lynch. Thanks so much for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.